Okay, we are live, and I am with Jamie Litzler from Marcus and Millichap. Sorry, we're late to the party. If anybody's actually trying to watch this at this current time, but we had some technical difficulties, and neither of us are the technical gurus. But we were able to figure it out. It only took 15 minutes,
That's right.
so but we're here. So I wanted to talk with you guys, or I want to talk to Jamie, and I wanted to do it in this setting so that if people had questions or there's other concerns or there's just things going on that are kind of crazy that they're seeing that we're seeing, that maybe he'd be able to lend some of his expertise and we'd be able to kind of learn and see what's kind of going on in the market. So, Jamie, maybe give a little more in-depth intro. I know you've been on with me before and we work together a lot, but for those that don't know you,
Yeah.
um,
Quick refresher. So, mortgage banker at Marcus and Millichap. So, my job every day is to raise debt and equity across different product types, different real estate classes with different institutional lenders. We work with all sorts of lenders: Fannie Mae, Freddie Mac, the CMBS World Life companies, and then banks and credit unions and bridge lenders. So, quick background: we work with all different lenders on all different product types, and our job's to just arrange debt and equity that best aligns with our borrowers, like you, Seth's business plan. Whether it's an acquisition or a refinance, just learning your objectives, your investors' objectives, or your partner's objectives, and making sure we're hitting as many of those as we can to execute on your business plan.
yeah, that's great. And so, like, I guess for everybody watching, one thing that I can say is that Jamie and I have done, I don't even know, maybe 30 million in deals so far, somewhere in that ballpark. I can tell you that in every deal that I've ever brought him that he says he can close, he closes, which is huge in the deals that I'm in because certainty of execution and being able to close it is right up there with the purchase price, especially in today's environment. So, working together, he's very trusted, very knowledgeable. I originally worked with your brother Chris, who's in Cleveland, and then, like I said, when we met, it's just been great. The last couple of years, I'd say 3 years maybe, we've done a ton of stuff together. I wanted to have you on again just to kind of expose everybody to what you're seeing and maybe some of the guidance that you can give, because obviously things have been tightening up. Lenders are having issues with liquidity. They're having issues with just doing loans in general. I mean, I know there's some people that we've worked with in the past together that haven't done loans in months, or are shying away. We're seeing it in the insurance world where they're just dropping us for no reason at all, other than they're
Yeah.
just changing their risk profile. And same thing with the lenders, which for those watching is why we work with Jamie's, because Jamie can go out to 40 lenders in the same amount of time it would take me to go to one lender, and really give us kind of a wide spectrum of different people to work with and different lenders that have different appetites for things. And so again, that all leads back to that certainty of execution. So on the liquidity standpoint, or I guess even lending in general, like what are you seeing as far as the relationships that you have that maybe were kind of always your go-to?
Yeah.
How have those changed in the last 6 months?
Dramatically. I mean, we're going to different lenders that we've frankly never worked with because they're more active than others. We've got, I'd say, for every transaction, you used to say, call it, there were 10 go-to lenders. I'd say now we're down to 7. You know, 2 or 3 here and there have dropped out, come back, gone on the sidelines, and that funnels through time. But over the last 12 to 18 months, we've definitely seen a few pull back. Not so much because they're concerned over risk or they're tight on capital. They're just taking a pause to see where the market goes with all the uncertainty we've had. So I'd say there's a few reasons for that. One is uncertainty. 2 is folks are paying a lot of money on deposits, right? You used to go to JP Morgan, get 0%, and you'd go to a community bank and you'd also get 0% in the savings account. Well, now they're paying 4 or 5% to keep your money. So it's just getting tighter on their books. So it's, it just doesn't make sense to put on mortgages when you're doing that right now. So that's one. 2 is, there's just a lot of uncertainty on how high rates go, right? So they're kind of pausing there. But there's still 7, 8 different lenders that are still active. When I'm thinking community and regional banks, the rates are just higher.
Mhm.
And a lot of folks want some deposit accounts to go with it. So a lot of banks are saying, I'll give you 75% leverage, but I need 10% deposit. So your leverage just went to 65%. So that's the nice thing about coming to us is we're going to go to those 30 banks and make sure that we present the deal accordingly and kind of weed out those that don't make sense for you or any other business plan.
Yeah. So what are you seeing like rate wise? I mean, are you seeing, I mean, what are the conversations? Obviously the Fed just raised their rates again, which, maybe explain to people, when I understand it, but I probably don't explain it as well as you would in financial terms. But when the Fed raises that rate, how that affects the banker, how that affects the way they lend money between banks, and then ultimately how that is affecting us who are the investors going and trying to get that money.
Yeah, so the Fed funds rate doesn't really drive commercial rates at the end of the day. Some banks do adjust their loans accordingly or their interest rates, but that's the overnight borrowing rate for major large institutions. So that trickles down, right? So any bank that, for example, on a deal we're hopefully working on here soon, one bank, they may not have all the capital necessary to go put out a, call it $5 million loan. So they have to go borrow those funds to give you the money. So if they're going to borrow those funds, they're paying a lot higher interest rate than what you're used to seeing over the years. And then if they're borrowing their funds, they're not just going to give it to you at a cost neutral, right? They need to make some money too. So then they're charging a spread above that, and that's driving up your borrowing costs. So the Fed funds is, for 5-year, 7-year, 10-year interest rate loans for commercial real estate. We're not really tracking the Fed funds and what Jerome Powell
Mm-hmm.
says, but that does trickle down into what happens to the treasury market, what happens to banks' capital, and what happens to the availability of the bank's capital.
Yeah, I feel like that's really the thing. Like everybody freaks out when they hear the Fed raising the rates, but I mean, it doesn't really trickle down, like you said. I feel like there's a 6 month lag or something. Maybe it's not that much, but there's a lag between when something happens, even last year, and then even now, where I feel like at least for us, because we're on our third refinance, in the last 6 months, where we're feeling that squeeze. Luckily, the properties that we have are in a good enough position where they're cash flowing still. They're doing well. You know what I mean? Like there's not like some big giant, we're not triggering some big problem. Like some of the other things that we've talked about, or the other deals that are out there where they have bridge debt, or they didn't buy the rate cap on something, and it's completely like killed their deals. We personally haven't seen that, but have you
I will
seen or dealt with, you got folks calling you, they're in those scenarios where they're stressed out looking for a solution?
I will say, just to touch back on that last question, is if you're doing shorter term interest only loans like bridge loans, like Lima One, they're more tied to that. That's that from Jerome Powell and the Fed fund. So that's an example. Large bridge loans, those are higher and more tied to the shorter end of the curve, and Jerome Powell adjusts the very short end of the curve. So that does impact those loans, but that's not what we're doing right now for you or for many folks, right? Because they are so tied to that curve. But yeah, on the longer end, not so much. I'll say, to answer, current deal, I would say is yeah, your three refis have been phenomenal. But I think the interesting thing about your three refis is the difference between the winning bank and everybody else, right? There's a
Mm-hmm.
huge difference between the chosen lender and others because there's so much variety out in the market.
Yeah, and I think that to kind of go back to what I said earlier with like we're even working with you or somebody like you, right? I mean, I favor you, right? Because I think you kill it for us and you do very well. But is that me going to like because that's I talk to guys locally here in Columbus and they're doing $1, $2, $3 million deals, and they're going to their same guy, and all of a sudden their same guy is no longer interested, or he can't they can't believe some of the rates that we've been able to get. And I'm like, well, that's the difference is you're going to your one lender or maybe two local lenders, and we're going to one person who's putting it out to 30 or 40 lenders, or depending on the asset and the type and where it's at, what that looks like. But so I think that's what's allowed us to get really, really good rates, really good deals. And even in that scenario, how have you seen loan structuring change, or how is that like, how have those like on two of ours, we've had really
Yeah.
great where they've kind of like structured the loan differently than I'd seen before, but it ultimately was able to give us a great rate, no prepayment penalty, like
Yeah.
the years we had to have the loan matched our timeline and our business plan. So like, have you seen a lot of banks, or is it just mainly a select few that have been willing to work, to kind of win the loan?
Yeah. So I'm going to answer that two different ways. 18 months ago, how you anticipated us refinancing the ones we're working on and have worked on, probably wouldn't have expected us to go this direction 18 months ago, rates hadn't started moving, probably would have gone long-term, non-recourse, 30-year amortization, right? But by where we are in nature of interest rates and in the current market, interest rates going up have hurt our debt service coverage, right? So we're no longer LTV constrained, right? Your lender could say I'm 80 or I'm 60% constrained. Odds are, the LTV is not going to be the issue. It's going to be in place cash flow relative to your debt service payment. So that's the only real structuring change there's been. Yes, some lenders might not go to 80% leverage like they used to on an acquisition. Now they're at 70 or 75. That there's a slight, maybe a little bit of leverage pullback on some folks, but we're coverage constrained on our cash flows. So that's kind of the change in structure, is we can no longer go guarantee a 75% loan at a 125 cover because it's 6.5 or 7 or 7.5%. That's more like 60 or 65% LTV. So to make it work is you got to get creative on the cash flows, right? Sell a story. We're really big on that, as you know, is we might be clipping along really well for the last few months, but how can we make it look like we're still below market or there's still room to push is kind of what we're trying to do, or, sell a story on some expenses. And that's why we really dive in on the front end. So I'd say loan structures haven't materially changed. You're just not getting the same products you thought you would have with lower rates because you just can't push the leverage. And we also think if rates do come down in a few years, you don't want to be stuck with a big prepayment penalty. So that's why we've looked at a local community bank or credit union and said, can I get a flexible prepayment penalty while having some long-term fixed rate debt? So that's kind of the best of both worlds. It's not the lowest rate that's out there, but you do have some protection if rates come down in 3 years and you sell. Well, now you've got no prepay, so you just made up for that difference in the rate pretty quick.
Yeah. So a couple of things you said there that I find interesting is that, like, how the rates have because the rates have changed and now you can't meet the debt service ratio. It really kills. Like we bought a property 2 years ago. We're about ready to refi it. We thought we'd be able to get 50 to 60% of the original capital out, and it's there. The value's there. We've created the value. We've worked the business plan. Everything's happened. But because the rates are so high and the lenders aren't willing to go that, they're not willing to give out that much free cash right now. It's tightened up to where, we're able to get out enough to catch ever, for us, if we syndicated, catch up our LPs on any initial pref that got deferred on a value add, which in this scenario, it was deferred for the first year. But, that's the thing that it's really, I wouldn't say it's killing, but like the value is still there to be recognized later, right? When we go to sell, the value is still the value, in my opinion, but we're just not going to be able to access the full value like we would have been able to before, because like you said, we're stuck at 65% versus before you would have went to 80%. And we would have been able to get out more cash to be able to pay back an LP or to be able to do whatever you wanted to with that money. Now that money is that new value is still there, but it's trapped in the deal really until you sell, which again, the rates that we're seeing right now are affecting the values, even though sellers haven't adjusted their pricing. Like for us, I'll just wait it out, right? I mean, if I got a good asset and a solid rate, I'm just going to wait a couple of years and then we'll see where things are at.
Yeah, I would say we haven't seen, as the acquisitions we've discussed, there has not been a slowdown at all in price. People are still willing to pay egregious amounts for multifamily, in this case, for well-located real estate that just, even if they don't pencil today, for in-place cash flow, they still make sense because of long-term rental growth and appreciation and principal pay down. So you can still sell real estate, and in my opinion, pretty quickly. And people can still find acquisition financing. It's just not at the same leverage. Mm-hmm. And if you can't get the same leverage on the acquisition, you're probably not getting the same amount of cash out refinance.
Yeah. Yeah. So that's some of the conversations that we've had with LPs is like, look, I mean, the deal is great. You're still making your prep. You're still getting paid. It's still cash flowing well, but the value's there. You can see it, but we just can't get it out right now because of the way things are. And I think, like I was talking about earlier before we got on the call, a lot of the conversations that we've had with LPs, they're just happy to be getting money. You know what I mean? That we're not in a scenario where we're having to do a capital call, or where the cash flow is dried up so much. That was because what's interesting is, like, when we bought 2 years ago on some of our stuff that we did with you, our bridge debt was 6%. Yeah. And now, and now which was high when it was 3% long term. And then you're refinancing out now, and our rate is going to be, 6.5 I think what do we got, like 6.8% or something like that on this last one. But still, you know, the thing cash flows and does well. Everything, it's still healthy property. It just, to me, it shows how good of a deal it was when we bought it.
Yeah, and the other thing that I do on the sidelines that you probably don't even know is, we have our models on the front end when you buy the deal, in place and pro forma. And on every one of our refinances, we go back and we say, how did performance compare? So, our pro forma that we sized on the front end is where you're at now on a current basis. It's just, when you look back at our package, we had a 4% on a 30-year AM, and now we're at a 6.75 on a 25-year because some banks are just pulling back on amortization. Like, you certainly, you did everything you could. You just can't control the market.
Yeah. Yeah. So, I mean, I guess what are you seeing too, like on, because again, I know my scenario and what we do, but like in you're privy to a lot of other people. What are you seeing as far as lender requirements for net worth, liquidity? You know, what are they putting on the group buying or the individual buying? How has that either, gotten tighter or gotten worse, I guess, or those
Yeah,
requirements have gotten higher?
so used to be net worth, liquidity, pretty simple: 100% net worth, 10% post closing liquidity, and some sort of experience. I'd say theoretically the numbers haven't changed, but banks do definitely focus in on it more. So I'd say 150% net worth and maybe 15 to 20% post closing liquidity. But the big thing's experience and experience with like kind assets. So experience owning similar real estate. Refining 60 apartment units or buying 60 apartment units, they want to see that you've got 30 or 40 or 50 that you operate currently and have been able to operate through this kind of uncertainty. Now, it's not by any means COVID where everyone's looking around like what's going to happen.
Right.
But it's still a little tighter, right? There is uncertainty over the next couple of years about rent growth or operations or what people can do. So having a good quote unquote resume ready to go with your real estate experience goes pretty far now. And you can't really put a dollar amount or a value on that, but that's pretty imperative. The other thing I would say is a lot of banks and lenders are looking at near-term roll on current loans. So while that doesn't really impact your net worth or liquidity, it could, right? If you've got a floating rate bridge loan that you did 2 years ago and the cap's about to expire in 8 and 12 months, a bank might start to ask that question of, what's your refi strategy there? So not a ton of real different changes, but certainly a lot more questions and a lot more digging in by lenders.
Yeah, no, I 100% agree. And that's what we've seen as well. John made a comment on Facebook that agency loans are the best way to go or the best way to go now. And so let's talk about that because I think that agency debt is great. It's great on Class A assets that you're going to hold long term. But for us, they're not the best way to go. And the reason I think that is because our hold strategy is only 5 years. And like we saw with a lot with COVID, we had guys that had 6.5% agency debt pre-COVID, and then when the rates dropped to 3-4%, their yield maintenance went through the roof, and then they couldn't sell. And there was a lot of people a lot of deals that we looked at where they were trapped in the loan. They wanted us to assume it, otherwise they're gonna have like $1 million prepayment penalty. Some of them were even higher than that, and they couldn't sell. Like it just killed the value of the deal. So I think that, at least personally, agency debt is great. But it's not, if you're planning, if you're buying something and you think you're going to sell in 3 to 5 years, I personally wouldn't want to lock into agency debt because usually they're 10 years out. And, to me right now, the rates are going to change. I think the rates are going to go down. It might be 3 years from now, but there's going to be some kind of adjustment. I don't think it's ever going to go back down to 3 or 4%, but we level out in the fives. I don't want to be stuck I don't want to be stuck at a bad rate.
I would say, kind of goes to my first comments is, it all depends on your business plan, right? If there's a chance you want to sell in the near future, or your property isn't in what I'd consider a standard market, which is where agencies can go their lowest level line coverage, agency financing might not be the best option. Now, if you're solo and you're good with 6% over the life of your hold, and that might be 20 years, lock it up, put it away for 10 years and let it cash flow. But if there's a thought that rates are closer to 4 versus closer to 6 in a couple of years, whether that's 4.75 or 5.25, who's to say? None of us know. But yeah, then you might want to reconsider locking it up for 10 or 7 or 5 years. agencies do have some sort of flexibility in the prepayment penalty. You price that in, it gets more expensive, but that lowers your loan amount. So it all depends on the
Mhm.
business plan and your whole period, really,
And I
and your
think like,
investments.
yeah, and like you kind of touched on, I mean, I think that if you're buying a B plus A class asset in downtown Columbus, right, or in a metro area like that, I think you're safe doing agency all day long. But if you're in a secondary, tertiary market, wherever you're at, I mean, agencies again, in my experience, won't touch a lot of those, or they want an arm and a leg for it, and it just doesn't make it doesn't make sense, especially if you're
And
syndicating those and you're trying to
and
keep as much
historic
equity as you can.
and historically in a smaller market, unlike an hour north of Columbus, an hour east of Columbus, an hour south of Columbus, you know, the debt service coverage that those agencies required wasn't a big deal, right? Because you didn't have a hard time hitting a 135 cover on a refi because rates were 4% or 3.5% or 4.5%, even 5, right? You had no issues. You were leverage constrained at that point, not coverage constraint. So there's a time and a place, and hopefully in the near future, that time and a place will be back, and we can all lock them up for 10 years and ride the wave again.
Yeah, yeah, for sure. So what are you seeing like ground up, like I know you guys, because you guys do all, we talk about multifamily because that's kind of like our bread and butter, but we're doing ground up construction, which we've talked about. We have two really big construction projects that are going to be, they're going to be I guess I would call it the anchor assets in two funds that we're doing. So that, but what are you seeing in ground up, or I know you guys are doing hotels, you guys do various different asset classes. Like, are you seeing similar things across all these assets, or, I mean, or is it just multifamily you're seeing or are you seeing somewhere like they've stopped lending on altogether?
Yeah, so office.
Oh yeah.
Office is tough, but we'll skip that for the time being because I don't think a ton of us are doing it. But I'll answer construction first because it goes in line with what we just talked about. Construction loans, they're underwritten based on future cash flows and their expected cash flows, but they're also underwritten based on current interest rates. So if you are, you know, underwriting in 3 years what you think rents are going to be, but you have to use today's rates, not knowing what rates will be in 3 years. I got to use what your current loan would be. That's really tight, right? That is
Mhm.
another example of coverage constraint. So I would say construction loans still getting done, still a lot of interest, especially in our market, right? You can't build them fast enough in Central Ohio for people to live in, but you got to bring just a little bit more equity because you just can't hit 85% leverage on a construction loan like you used to. And that's simply just because of interest rates and what they have to size to on an exit. But I'd say, apartments are most of what we do. They're the most favored asset class by most lenders, but they also have, generally speaking, some of the tighter cap rates. So the tighter cap rates with where rates are brings leverage constraints. So you don't have that same issue with, strip retail, right? When that's going off at 7, 7.5, 8 cap versus an apartment at 5.5 or 6. Generally, you've got some more room before your coverage constraints. So, and that can be said for other asset classes as well. Storage and warehouses are, and industrial pretty tight on cap rates as well. So everyone's feeling it from a going in debt service coverage and leverage constraint. But some are feeling a little tighter than others just based on what the traded cap rate is.
Yeah. Do you feel like cap rates have expanded like more? I mean, at least for us, we've seen them expand more like in some of the tertiary and secondary areas. They've, even if we underwrite it, we traditionally underwrite everything to expand at some point from the time we bought it till we sell it, which you should do. But yeah, I would say that they've softened even probably more so in the last year and a half than we probably expected to over a 5-year horizon. And if you're able to hold and just sit tight and kind of see, like you said, kind of ride the wave. You have maybe your 5-year loan, or you're locked in. But have you seen that in Central Ohio on a broader spectrum, and then also in other markets that you guys are dealing in? That is that that kind of happening everywhere?
Yeah, I would say, like, let's for example stick Central Ohio and some of the transactions you've looked at and we've talked about. Sellers' expectations of where cap rates and where prices should be have not changed material in my amount. Maybe a little bit, maybe 5-10% off what price would have been 18 months ago, but people are still paying it.
Mm-hmm.
And the people can still pay a 3 and a 4 and a cap on an apartment deal if they're well capitalized, and they don't need 75% leverage. So yeah, there's been some softening. Has it been nearly as much as you would expect for rates doubling? Absolutely not. And I think every market's going to be generally different. Columbus, Ohio has just done very well recently from a headwind standpoint. They've clearly seen a lot of growth. I hate to just always refer to Intel, but Intel plus others. I mean, Amazon spending as much as they have over there. It's hard to see cap rates going up in Columbus, Ohio, when they've stayed where they're at for 18 months in all this rate rising environment. And I'm sure other markets can say the same, but I'm certain other markets can't. So some softening, not nearly as much as I'd expect for where rates have gone.
What about like volume? Do you feel like, I mean, I know the residential mortgage guys I talk with regularly are like, they're getting killed, but do you think the transaction volume, from what you're seeing and dealing with, you're kind of all dealing with different people all over the spectrum, is it, have you guys noticed the slowdown as well?
Yeah, that's the other reason I don't think prices have moved much is there's no volume, there's no activity. There's hardly deals to be had or available for sale or for purchase, I should say. There's just not the same quantity of transactions available to purchase as there was 18 months ago. So less supply, more demand. So I think that also plays into it. I mean, I also look into single family spaces. There's no houses to buy either, right? There's just not a whole lot of availability in the single family market. And I think that's the same with the commercial real estate space. But transaction sales are just generally down. I mean, if you look at a lot of the publicly traded sales brokerages, Marcus being one of them, I think you can see in the earnings report that transactions have just generally been down a lot.
Yeah.
Which doesn't help price reductions, right? That you've got one deal for every 5 last year, it's pretty hard to see prices come down.
And that's what the crazy thing is. I mean, like you and I were working on a deal here locally that, the ultimate winner of that deal came in and paid $1 million over anything that made sense and offered cash. I don't know if they actually ended up closing or going to close in cash, but that's what won them the deal. And it's not the first one that we've lost like that, where we've underwrote everything accurately and very dialed in. And then somebody comes in like that and is just like, I don't want the debt. I'll just pay cash for it. And maybe I'll refinance later.
Well, that's the other thing that you and I have talked about a lot is fundamental real estate is irreplaceable. That transaction you're referring to, among others that have gone like that in Columbus, are irreplaceable. Now, that means you're going to have to hold for 10, 15, 20 years, but how much are you willing to buy into that for 20 years, 30 years, families, generations of just natural price appreciation? That's the great thing about real estate, but that's the tough thing about the market right now.
Yeah. Well, and that's why, like, even for us, like, we're doing when we've talked about it, but our land fund for Central Ohio, and then even this is a multifamily fund. I mean, we're finally doing something that's going to be 506C, so we can talk about it, because everything else I do is 506B and everything's just kind of quiet. But it's the same thing for us when the amount of land opportunities that we have coming at us because of the growth that we're seeing in Columbus, because of Intel and all the buzz with that, and Microsoft and Amazon. And I mean, it's just craziness that's coming here. But all the groups that we talk to in the West Coast and the East Coast, they all feel like this is going to be like another Silicon Valley event, and they're all dying just to get in, and just, it's like a land grab right now. And if you can, the great thing with us being and you being local here is that, we're in the meetings with the water and sewer departments, and we're in the meetings with some of the best engineers in the city, and knowing what's going on and where is the utilities going, and getting out ahead of that. And which is why we're kind of changing our structure, right? As we've always syndicated, but it's like, if we can put 2 or 3 assets in one, in a fund, but almost, it's similar to a syndication, the fact that you're getting some diversification of that. But that land, the reason why we like it is like what you just said, is that if we can buy it now and hold it for 10 years and develop it in 5 years or 3 years or whatever, like, I mean, it's going to be irreplaceable. And I can tell you in 10 years, what Columbus looks like is not going to look like it does, at least out where I live, right in Licking County.
Yeah, I mean, yours is
the farmland that you look at now is going to be gone.
I
in
mean,
10 to 15 years.
it's interesting to think maybe that was 6, 7 months ago. We were having a conversation about construction workers for Intel needing a place to stay on your land, right?
Yeah.
Because there's just not enough housing for people to build Intel and Office and Amazon and whatnot that's going out in your neighborhoods. And the fact that we couldn't even house the construction crews, let alone the people that are going to work there when it's done, is pretty wild.
Yeah. And so on those scenarios, like, how are you still, like, I know, like, but when we originally talked about it, the first development we're doing, it, we talked about it even over a year ago, was more like life companies were interested and they were going to do, kind of like something we were leaning towards. But how are you seeing that where, uh, you know, we bring you that deal and we're saying, hey, we're ready to do, we're ready to get our loan to start doing the vertical development. Like, who's playing in that space right now, and what does that look like?
Yeah, I mean, general horizontal, construction is generally a banker, a local bank is generally the best play for a multifamily construction loan and an office construction loan, that kind of construction. There are life companies that do construction to perm, or HUD does construction to
Mhm.
perm on apartments. I'd say the life company space has dwindled for that. There are $50+ million check sizes and they're low leverage. So it's a great option if you're just going to put it to bed, but it's not overly realistic in my book for people that are bringing in equity partners, right? If you're doing a $50 million construction project and you get 60% leverage, it's a lot of equity. So your best play is a local bank for that stuff. They know the dirt, they know you, they know the rent growth, which is going to be off the charts. We just can't underwrite to it because it doesn't make sense,
Right.
but they're going to understand it the best and be your best resource for that capital.
Yeah. Well, again, like you just said, it goes back to relationships, right? Local banks, or local regional banks, I should say, local banks. Most local banks can't do what we're doing, or they're stuck at $1 million, and then they're gonna have to call that other bank. At least
Yeah.
I just had a buddy of mine he's doing a development in Hocking Hills, 50 acres or whatnot, and
Yeah.
he thought he had a bank lined up, and I said, be careful, because once you get that $1 million, they're going to be having to bring in a supplemental banker. They're going to kick you to somebody else
Yeah.
who has a bigger backing, and that's exactly what happened. Is that he
Yeah.
almost lost the deal because he was out of time with the seller, and then the bank backed out, and he then sent him over to a different bank, and it's just been we were able to connect him with a private money lender that basically gave him cash to buy the loan and until he could refinance it. But that's, again, relationships right now are very, very important.
Yeah, there's a sweet spot out there that most people don't know, right? You think of the one-off bank you see driving by, like Buckeye Bank or Ohio State Bank, who's probably a really great bank, but they're capped. And then you go to JP Morgan Chase and they're not interested in anything. So there's
Yeah.
a weird sweet spot out there in the commercial mortgage loan department for banks.
Yeah. Yeah. Very good. All right, man. Well, like I said, I appreciate you jumping on. I mean, I think we've kind of answered the questions that I can see, at least. So if you ask questions and we can't see it on our end, we'll respond after this. But I appreciate you coming on. Just wanted to kind of touch on the market, what you're seeing, what I'm seeing. Like I said, you and I are working on our third refi in the last 6 months, which has been great doing that with you. And like I said, you're part of the reason we're successful. So I wanted to just introduce you to those that are in Ohio, and then also kind of lend out your expertise. So if you guys don't have, I should say, if you don't have a lending broker or you're stuck, give Jamie a call or reach out to him through social media. How is the best way for people to get a hold of you?
Yeah, I'm on the Marcus and Millichap website, but I'll put my name in my email in the video below and the Facebook or comments or whatever, so people can reach out direct.
Okay. And the biggest thing for you guys, and I shouldn't say you don't do less, but like $1 million or more is kind of your threshold for, I don't want to say being worth it, but I mean,
Yeah.
that's kind of that's what you've told me, right? I mean, is
Yeah,
it
yeah.
like, if it's $1 million or less, it really doesn't make sense for you guys to engage with us. But if it's over that $1 million mark, then, give you a call and see what you can do. And like I said at the beginning, you guys, if you reach out to Jamie and he can do it, he's executed 100% of the time for us. And if he can't, he's very upfront and will tell you he can't. And here's why. And I think that's also huge on your end to do that, because you guys can, you have a whole team of people that look at our deals and you see it from a different lens. So maybe we're missing something, or, hey, have you thought about this? Or have you thought about that? And it's very, very helpful.
Yeah, I mean, we're happy to help sub $1 million. It's just our cost is punitive at that point for you and your, anyone that's looking, right? So it's just you got to pay our fee plus the bank's fee underneath the million. Just it gets a bit. Our value isn't created as fast. We'll put it that way.
Yeah.
So
Yeah.
appreciate you having me. Glad we
Yeah,
could
absolutely, man. Great chatting, and appreciate your time. And we'll answer any other questions, or like you said, either you or I'll put your information in the comments.
Awesome.
Well,
Thanks for
all right,
having
man. Have a great day. Thank you.
me. You too. Bye.
See you.